In the past year alone, I have closed over $40 million in multifamily acquisitions. Now, I didn't use any of my own money when doing this. I used other people's money, also known as OPM. And in this video, I'm going to show you the exact 90-day system I use to find, underwrite, finance, and close apartment buildings so that you can do the same thing. My name is Todd Robinson. I'm a real estate finance and investment attorney. I've got my own law firm here in Atlanta, Georgia. I've also personally built a portfolio of over $85 million in multifamily assets. That's over 750 units. And I've structured billions of dollars of commercial real estate transactions for clients across the country. But here's what makes me different from every other multifamily investor teacher on YouTube. I'm not just an investor who did a few deals and now sells courses. I'm a practicing lawyer. I structure these deals every single day for clients nationwide, and I'm actively acquiring properties for my own portfolio right now. So when I teach you how to buy apartment buildings, I'm not teaching theory. I'm teaching you what is working in the markets today from both sides of the table. Now, I need to be honest with you and upfront. This video is long. It's 30 to 45 minutes of just pure content. No fluff, no filler. If you don't have the attention span to watch it all the way through, then take notes and actually implement what I'm about to show you, then just click off now. But if you're serious about acquiring your first multifamily property, escaping the corporate 9-to-5, building passive income, and creating generational wealth using other people's money, then this is the only video you're gonna need to watch, my friends. By the end of this free course, you will have the complete 90-day framework to go from zero to closing your first 20 to 100 unit apartment building. Now, I'm gonna cover why multifamily beats single family investing every single day of the week. The exact 90-day system broken into 3 phases. There's foundation, underwriting, and closing. Real examples from my own portfolio. What worked, what didn't, what would I do differently? The legal structure you need to set up from day one to protect yourself and raise capital compliantly. How to actually raise capital even if you think you don't know any wealthy people. And the biggest mistakes I see first-time investors make that cost them hundreds of thousands of dollars. And at the end, I'll show you exactly how to implement this system. Whether you do it yourself or you work with me directly inside Multifamily Dealmakers. So grab a notebook, buckle up, pause when you need to, take this seriously, and let's get into it. So before we get into the 90-day system, you need to understand why multifamily real estate is the best wealth building vehicle available, especially compared to single family homes. Most people start with single family rentals because it feels safer, something they know, right? Buy a house, rent it out, you collect the cash. Simple, right? Here's the problem with single family investing. Let's say you own 20 single family homes. Congratulations. You now have 20 roofs to maintain, 20 insurance policies, 20 different tenants in 20 different locations, 20 separate properties to manage. It's a logistical nightmare. And here's the bigger problem. Single family homes are valued based on comparable sales. So that means you have zero control over the value. If the market goes up, great. So does your property. If it goes down, great, you're screwed. You can't force appreciation like you can in multifamily. Multifamily is completely different. Economies of scale with multifamily. You buy one 20-unit apartment building. Now you have 20 tenants under one roof. You have one location, one insurance policy, one property manager overseeing everything. It's infinitely more efficient and professional management. When you own single family homes, you're the landlord. You're dealing with tenant calls at 2 a.m. about broken toilets. With multifamily, you hire a professional property management company. They handle the leasing, the maintenance, the tenant issues, everything. So you're the owner, but not necessarily the operator. Single family financing is limited. You're capped at 10 conventional loans. After that, you're stuck with hard money and portfolio lenders at terrible rates. Multifamily financing is typically institutional. You can get Freddie Mac, Fannie Mae, bridge loans, CMBS, all with better, higher leverage, and non-recourse structures. I'm gonna break down all the financing options later in this video for you. Forced appreciation. Here's the biggest advantage. Multifamily properties are valued like businesses, not like houses. The value is determined by the NOI, net operating income. That means you can force appreciation by increasing income or decreasing expenses. Let me give you a real world example from my own portfolio. We bought a 59-unit property in Milledgeville, Georgia for $5.5 million. It was a value-add deal. The units were outdated, old kitchens, no backsplashes, dated lighting, things like that, worn carpet. We were charging $1,200 a month for a 2-bedroom unit. We came in and renovated all the units. We put in new countertops, new backsplashes, modern lighting, fresh painting, new flooring. It cost us about $6,000 per unit. But after the renovation, we were able to charge $1,500 a month for rent. For those exact same units, that's an extra $300 per month. Now multiply that by 59 units, that's an extra $17,700 per month in gross income. That increased our NOI by roughly $10,000 per month, or $120,000 per year. That's real value. And this is where it gets interesting. Multifamily properties are valued by taking the NOI, you divide it by the cap rate. And in that particular market, properties were trading at about a 7.5% cap rate. So when we increase the NOI by $120,000 per year, we divide that by 7.5%, and we just added, folks, $1.6 million of value to this property. And we spent $350,000 on renovating it and created $1.6 million of equity. That is what you call forced appreciation. You can't do that with single family homes. There's also huge tax benefits through multifamily investing that provide massive tax advantages through what's called depreciation and cost segregation. When you buy a multifamily property, the IRS allows you to depreciate the building over 27.5 years. But with cost segregation, you can accelerate that depreciation and take massive paper losses in year one. Now, I've had clients and students who are high W-2 earners making $300,000, $400,000 a year. They're getting crushed by taxes. They buy one $2 million multifamily property, do a cost seg study, and generate $400,000 in depreciable in year one. That $400,000 paper loss offsets their W-2 income. We also train them on how to become what's called a real estate investment professional to qualify to offset passive losses from active income. Now, they do this legally, right? So they go from paying $120,000 in taxes to paying zero. That is the power of multifamily real estate investing. So to summarize, multifamily gives you economies of scale, professional management, better financing, forced appreciation, and massive tax benefits. That's why I only invest in multifamily, and that's why you should too. Now, let's get into the system. So the 90-day multifamily acquisition system is broken into 3 phases. Phase 1 is the foundational time period, between 1 to 4 weeks. This is where you set up your legal structure, you pick your market, you build your broker network, you create deal flow. And I'm with you the entire way, right? Number 2 is underwriting, phase 2 rather, weeks 5 to 8. This is where you analyze deals, you submit offers, and you get a property under contract. Phase 3 is closing, weeks 9 to 12. This is where you secure financing, you raise capital, you complete your due diligence, and you close the deal. Each phase is built on the previous one. You can't skip steps, okay? Most people fail because they jump straight to phase 2. They start analyzing deals before they set up their legal structure or they built relationships with brokers. That's backwards, guys. You need to build the foundation first, then you underwrite, okay? Then you close. Let me walk you through each phase step by step. So in phase 1, the foundational period between weeks 1 and 4, right? We're going to form your legal entities. That's the first thing you have to do. Form your holding company. We're going to make sure it's set up correctly. This is honestly where most people screw up because it ends up costing them later. You need 2 entities. You need your holding company, which is your brand, right? This is what you present to brokers and investors. And then we're going to form a deal specific entity. This entity is the actual entity that owns the property. Now, here's why this matters. Your holding company is your credibility vehicle. It's how you position yourself in the market. Let me give you 2 examples from my own students. I had a corporate Delta executive who wanted to raise capital from high net worth Delta pilots and employees. We named his holding company Altitude Equity. Perfect, right? It immediately signals who he serves and builds trust with that audience. I had another student who works in construction. We focused his efforts on raising capital from construction workers, guys who are cash rich but have no idea where to deploy that capital, right? His holding company reflects that niche. Your holding company should be an LLC. You should use the entity to sign offering documents. You can sign your pitch deck. You can even put deals under contract. But the deal specific LLC is what actually takes title to the property. And this protects you from liability. If something goes wrong with one property, it doesn't affect your other assets. Now, as an attorney, I can't stress this enough. Do not skip this step. Don't buy a property in your personal name. Do not use a single LLC for multiple properties. Set it up right from day 1. Moving into weeks 2 and 3, it's market selection. So next, you need to pick your market. Don't try to be all things to all people. Don't analyze 15 deals in 15 different states. Pick one market, maybe 2, and become an expert in that market. Now, I focused on the Southeast, Georgia, Carolinas, Alabama, Tennessee, and parts of Texas. Now, why? Because these markets have what I'm looking for: population growth, job growth, landlord-friendly laws, strong rental demand, and affordable entry points, right? I've seen investors lose $50,000 in earnest money because they didn't understand the contract terms. Simple mistakes, right? Once the PSA is signed, boom, you're under contract. Congratulations. Now we move into phase 3. And phase 3 is really where we start week 9, and that's securing the financing. Now you need to lock in your loan, right? There are several types of multifamily financing for you to use. Community banks, good for smaller units, smaller deals. Typical recourse loans, right, where you're personally liable. That's like bridge debt, short-term debt, 1 to 3 years. Good for value-add deals because they'll usually fund a portion of the. And then higher leverage loans, 80% plus LTV. Higher interest rate typically, but they fund 100% of the renovation budget. Then there's Fannie Mae. Mae and Freddie Mac loans. By far the best terms for financing stabilized properties. Lower rates, 5 to 6%, higher leverage, 75 to 80%, and non-recourse, which means you're not personally liable. Now, that does require 90% occupied for 90 days, and so you got to make sure your property meets that criteria before you even apply for those kinds of loans. There's also something called CMBS loans, commercial mortgage-backed securities, similar to Fannie and Freddie, but a little bit more complex, good for large deals. Now, if this is your first deal, you'll likely use bridge debt or have a community bank. I have lender relationships all across the country. And if you work with me in our multifamily deal makers program, I will personally introduce you to the right lenders for your deal. All right, let's talk about week 9 and 10. We're getting into raising capital. While you are securing financing, you're also raising equity for the deal. Now, let's say you're buying a $5 million property. The lender gives you a $4 million loan, so that's 80%. You need to raise $1 million in equity plus another $200K for closing costs and reserves, which also includes your acquisition fee. So you need $1.2 million from investors. But here's the truth, guys. Raising capital is not about finding rich people. It's about building trust. Now, I teach a full capital raising framework inside Multifamily Deal Makers, but here's the high-level process for you to understand. First, you want to build your investor pipeline. You want to start with your network. Friends, family, colleagues, former classmates, people in your industry. Make a list of everyone you know. Literally go through your phone, mark them off. Who has high W-2 income? Who owns a business? Who has investable assets? Who's interested in real estate? That is your starting list. Now, number 2 is you want to nurture the relationships. Just like the brokers, don't pitch them immediately. Nurture them first. Send them market insights. Share articles about multifamily investing. Invite them to coffee and educate them on the tax benefits of real estate. Build trust over 3 to 6 months. Now, the third step of this process is you present the opportunity after you've had that time period to really nurture them. Go ahead and let them know when you have a deal under contract. Send them the investment offering, which again, in the program, we will help create what that investment offering is. But I'll tell you right now, what it includes is the deal summary, property details, purchase price, business plan, financial projections, cash flow returns, everything they want to know, right? The investment terms, minimum investment, if there's a preferred return, a profit split. Most of my deals are structured like an 8% preferred return to investors and then a 70-30 split of the profit with 30% going to the investors. But there's a million different ways to structure it. Investors love that particular structure because they get paid first, right? Now, step 4 in the capital raising process is you go ahead and close on the capital commitment once you collect the funds and they're wired to the title company. You need all the equity in place at least 2 weeks before closing, ideally. Lenders usually won't fund the deal until they see the borrower's equity in the title company account. So week 11 is kind of what we call your due diligence period. And so what you're doing is you're inspecting the property. You're going to go ahead and hire a professional property inspector, and they're going to check the physical condition. Things that you and I are not typically trained to test. They look at the foundation, they look at the roofs, they look at water damage, stuff like that. The lender will also hire an environmental consultant that will do what's called a phase 1, which is the environmental safety assessment. Then we'll also hire a surveyor to confirm the property boundaries. You're also going to review the rent roll. You're going to verify occupancy and rent amounts. You're going to review the leases, make sure they're valid. Review vendor contracts, see if anything needs to be terminated. If not, make sure you're okay with the terms. Utility bills, you want to verify all the expenses. I have a buddy who only invests in the Carolina, North and South Carolina. That's it. But he's become the go-to expert in that market. Brokers know him. Lenders know him. He gets off-market deals because of his reputation as a Carolina investor. That's the power of focus. So pick your market, study it, learn the submarkets, and go all in. You need to also understand the cap rates, the rent comps. What are the employment drivers in that market? I mean, generally to become an expert in that market, right? That's the goal. Weeks 3 and 4. What are we doing? We're building your broker network. This is the most important part of phase 1. Brokers control deal flow. Now, if brokers don't know you, you won't see any deals, right? Here's how you build relationships with brokers. Identify the top multifamily brokers in your market. Go to LoopNet, Crexi, 10X, see who's listing properties. Make a list of 10 to 15 brokers. Reach out with a professional introduction and a professional email address. Do not use Gmail, okay? They will not take you seriously, but don't ask for deals, right? Don't. Introduce yourself, explain your investment criteria, ask if you can get on their buyers list, and you follow up constantly. Brokers are busy. They get thousands of emails a day. You need to stay top of mind. Follow up every 2 weeks. Comment on their LinkedIn posts. Send them market insights. Prove you're a serious buyer. When they send you a deal, respond within 24 hours. Even if it's not the right fit, tell them why. Show them you're analyzing deals, You know what you're talking about, right? And over time, brokers will start calling you first when they have off-market deals. That's when you win. When you're known as a closer and a serious buyer, that's when brokers will start reaching out to you. In week 4, we're going to start creating the deal flow system. And by that time period, you should already have a system for tracking deals. I use a simple spreadsheet. Every deal I look at goes into the spreadsheet with property address, unit count, the asking price, cap rate, the broker contact, the status. Are we analyzing it? Did we pass it? Is it under contract? This keeps you organized and ensures you're not missing any opportunities. You should be analyzing 5 to 10 deals per week by the end of phase 1. Most of them will be garbage, and that's fine, but you're training your eye to spot good deals quickly. And if we're working together, I'm going to be asking you, why don't you like this deal? And you're going to be telling me why you don't like this deal and training your mind to find and spot the good opportunities. Let's move into phase 2. Phase 2 is week 5 to 6. That's when we're going to really dive into financial analysis and underwriting, right? This is the fun part. We start analyzing deals, right? Underwriting is the process of determining whether a property is worth buying or not. And here's the step-by-step framework that I use, right? First, there's the back of the napkin analysis. When a broker sends me a deal, I do a quick 5-minute analysis to see if it's worth digging in deeper. I look at the numbers. What's the gross income? How much rent is the property collecting per month? What are the expenses? What are the operating expenses? I always use a 50% expense ratio as a rule of thumb, right? Expenses should not be greater than 50% of the NOI. And if the NOI doesn't support the asking price at a reasonable cap rate, then I pass immediately. It's that easy. Let me give you an example. A broker sends me a 50-unit property. Asking price, $5 million, right? I pull the rental roll. The gross income is $50,000 per month, about $600,000 per year. I assume a 50% expense rate. That's $300,000 of expenses. The NOI at that point is $300,000 per year. If I divide that by the asking price to get a cap rate, it's going to be 6%, right? 300,000 divided by 5 million is the asking price, which is 6%. Is that a good deal? Now, it depends on the market. In Atlanta, 6% is okay for a stabilized property, right? It's not bad. Tertiary markets, I want closer to 7.5% or higher. And if the numbers don't work at this stage, I pass. If they do, I move to step 2. Now, in step 2, it's when we fully underwrite the model, right? I've built myself a full financial model that I use. I use Microsoft Excel, and we have input tabs. We actually input the actual rent roll unit by unit. We input each expense, the trailing 12. So we look at the profits and losses, put in all the debt assumptions, what's the loan amount, interest rate, amortization, value add assumptions, all that information you need in your financial model. And the model tells me, what is my all-in cost? What's my cash on cash return? What's my IRR, which is internal rate of return? What's my equity multiple? What's my projected sale price in 3 to 5 years? Now, if the returns hit my target, right, 15, 18 plus IRR plus a 2x equity multiple, then I move into the next stage. If they don't, I pass. Step 3, stress testing, right? I always stress test a deal and stress test my assumptions. Now, what if the occupancy drops by 10%? What if the expenses are 5% higher than projected? What are you gonna do? What if interest rates go up? If the deal still works under stress, it's a good deal. If it falls apart, I pass. You always want to look for a reason not to buy the property. Now in week 7, it's really the strategy, offer strategy, and LOI submission. So once I underwrite a deal and it pencils in, I go ahead and submit an LOI, right? It's the letter of intent. The LOI is a non-binding offer that outlines the purchase price, the earnest money, the deposit, the due diligence period, any financial contingencies, the closing timeline, everything you need. But here's the key. Your first offer is rarely your best offer, right? I typically offer 10 to 15% below the asking price. Why? Because there's always room to negotiate. Brokers will push back, sellers will counter. That's fine. It's part of the process. The goal is to get the property under contract at a price that will work for your returns. Now, moving into week 8, once we get the property under contract, once seller accepts your LOI, you move to actually documenting it and putting it into a purchase and sale agreement. And this is a legally binding contract. Now, as an attorney, I always review the PSA carefully. And what I'm looking for inspection contingencies, financing contingencies, seller representations and warranties. What are the earnest money terms, right? Do not sign a PSA without having an attorney review it. I don't care how nice the broker says it is. Deferred maintenance, right? Deferred maintenance issues, roofs, HVAC, plumbing, electrical. Your property manager will likely do that, but you can do it yourself as well. Now, if you find major issues, you can renegotiate the price and walk away. It's as simple as that, as long as your earnest money is refundable. Now, week 12 in our system is really closing day, right? That's when we get everything together, and you'll sign a mountain of loan documents, guys, believe me. Loan documents, the deed, operating agreements, right? Property management agreements, all of those ancillary documents the lender's gonna have. The lender then wires their money after you've wired your funds into the title company. The seller gets paid. You get the keys, and congratulations, folks. You have just bought your first multifamily building. I'm telling you, it is really that simple as long as you have someone in your corner showing you how to go about it. Before we wrap up, let me share some of the biggest mistakes that I've seen firsthand and first-time investors make. I want to make sure you avoid. Mistake number one, not setting up the legal structure. Do not buy a property in your personal name. Do not use one LLC for multiple properties. You need to set up a holding company, a deal-specific LLC from day one. Now, the second mistake is underestimating capital requirements. You're going to need more money than you think, right? Down payments, closing costs, reserves, renovation budget, they always cost more than everyone thinks they do, and it adds up quickly. So always raise 20% more than you think you need. That's also a good rule of thumb because a lot of people that you got soft commitments from may not even fund. The third mistake is partnering without an operating agreement, right? Never do this. Never do a handshake deal. I've seen partnerships blow up because rules were not clearly defined. So get an operating agreement in place and in writing before you buy. Mistake number four is actually skipping due diligence. I don't know who would do that, but I've seen it where, advice is do not waive your inspection contingency to make your offer more competitive. The general rule of thumb is buyer beware, right? So if you don't find something on the property that you could have found if you were inspecting it, you're done. You've lost it. So I've seen investors buy properties with $500,000 in deferred maintenance that they had no idea about. Always do your full due diligence first. The fifth mistake is using the wrong financing. Recourse versus non-recourse, it matters. It matters a lot. Prepayment penalties matter, understanding your loan terms before you sign. Expensive mistakes that you can avoid with the right guidance. All right, guys, that's it. That's the complete 90-day multifamily acquisition system. Now, if you followed everything I just laid out, you now have the exact framework to go from zero, closing your first apartment building in 90 days. But here's the reality, folks. Knowing the system and executing the system are two different things. Now, you can try to do this yourself. You can spend the next 6 to 12 months figuring out the legal structure, building broker relationships, learning underwriting, raising capital, right, and navigating the financing, all while making the expensive mistakes along the way. That's totally fine. Or you can work with someone who's already done it hundreds of times. I've closed over $85 million of multifamily acquisitions in my own deals. I've structured billions of dollars as a deal attorney, and I've helped students go from zero experience to closing 50, 80 unit deals in 6 months. Now, inside Multifamily Dealmakers, I give you direct access to me, right? Not a sales team or junior coaches, it's me, my broker network. We'll literally introduce you to the brokers that I work with, my exact underwriting models, the same ones that I use, my legal templates for all of my operating agreements, and my lender relationships. I'll connect you with exactly the same lender that I've been using. We get weekly deal reviews, we get weekly underwriting calls, and the guarantee, folks, is that if you don't close on your first deal within the first 6 to 12 months, if you don't, by following this exact system, I will keep working with you until you do. I don't know who else can make that promise in this industry. So if you're serious about acquiring your first multifamily property and you want an attorney investor guiding you every step of the way, then click the link in the description right now and apply to join Multifamily Dealmakers. We don't accept everybody. There are some serious requirements to be a member and a student in Multifamily Dealmakers. So you apply and then we'll have a conversation. Because I only work with serious people who are ready to take action. Now, if that's you, I'll see you on the other side. I can't wait. Thanks for watching. Make sure you subscribe to this channel for more content on multifamily investing, capital raising, and deal structuring. And folks, I will see you on the next video.